The seventh stock I ever bought was Magnato Wineries. It was a micro cap that traded on the Toronto Stock Exchange, probably had a market cap of around $15 million at the time. So this is a small company. I was searching for companies that were profitable, and I was looking for something that paid a dividend. I wanted something that had a little bit of yield. So I purchased 500 shares of Magnato Wines. It was trading under the symbol MGN. I bought 500 shares at 95 cents a share. This was in February of 2000. This fit the mold of the stocks I was looking for at the time. This was something that had a nice dividend yield and a low PE. The dividend yield was over 10%, and I didn't realize that that might have been a red flag. I just thought I was incredibly lucky to have found such a fantastic stock that I could buy. We'll see how my adventures in high-yielding microcaps turned out a little bit later. Now let's get to our guest. We are here with multi-patent inventor, investor, author, engineer, Afshin Moshrefi. And we're here to talk about everything and anything under the sun here. He seems like he's got a lot of good stories, but we do want to get to eventually his investing journey. But why don't we start with, looks like Boston University, go Terriers.
Yes. Hi, Terry. Yes, that's where I started my college. I went to undergraduate and graduate school in Boston University.
But electrical engineering doesn't sound like you were going into finance.
Not at all. I was electrical engineer, and then on my graduate, I studied solid state physics, the science of making integrated circuits.
Now, when you're doing that though, like is there tons of calculus?
It's not just that, it's tons of statistics.
Okay.
So in physics, there's tons of statistics. Actually, recently I was talking to somebody else about it, said, I don't know why so many physicists get into finance. And I think a lot of it has to do with understanding statistics well when you study physics.
Well, so I remember when I was doing my undergrad, I had friends in physics, and a lot of them were getting calls and recruiting from insurance companies and finance companies, because if you're doing well in physics, you know the math.
Right. No, but there's something called statistical physics, and it has to do with a lot about, I mean, at least I know in the context of solid state physics, which is the art of creating integrated circuits, the process to create it.
So what was the original goal? Were you looking to, I mean, did you want to be working at designing chips or what?
Not at all. Actually, that's a funny story. My mother came here. I'm originally from Iran. I came here when I was 16 years old, and my mother came here one day many years later and told me very upset, I don't know why you didn't go into aeronautical engineering. And I said, why do you mean? I never planned to do that. And she said, well, you used to play with model airplanes, so I assumed that's what you wanted to do. Like, well, you never talked to me. I always wanted to be an electrical engineer since the day my father brought a electronic calculator. I never forget that first time I ever saw it. And I was a little kid, and I opened it up trying to figure out how the heck does this thing work? And I knew I'm going to have to figure that out. And that was my real purpose of going into electrical engineering. When I figured that out, I was done. I didn't even study anything. I mean, I didn't work in that area anymore, but I finished in electrical engineering.
So what was it? Was it a little like a solar-powered Texas Instruments calculator that when you were a kid?
I'm talking about long time ago.
Oh, okay.
It was the first, I mean, I had seen mechanical calculators, but I had never seen an electronic one. And this electronic one was really old. But it worked. It was huge. It was the size of two encyclopedias next to each other. But it was a calculator, and it didn't do many things except add, subtract, divide, and multiply. That was about it.
Okay.
But it worked. And it was fascinating. I couldn't figure out how it's working. And that was my goal. My subconscious had made the decision after that. I had to know.
Okay, so then you did figure it out. You took you did your master's there, and then where'd you go from there?
From there, I got a job with Pentax Medical. as a sales engineer. At the time, my roommate, who was also my best friend, who actually got me into stock trading also, had a family friend who was the president of Pentax Medical, and they were looking for somebody who understands electrical machines and video systems because they were switching from fiber optic endoscopes to video endoscopes. And he recommended to that family friend to talk to me. And when we talked, they hired me instantly right out of college because I understood these things and nobody in that company did. And I started working as a sales engineer, and I've seen thousands of gastroenterology procedures and different versions of procedures. But while I was doing that, I saw a need for capturing images, and computers were just able to capture images from these video systems. And I bought a book on C programming, and I created the very first medical image management system for Pentax Medical. I didn't even tell anybody. When it was done, I told the president to come and take a look, and that was the last day I was a sales engineer.
They said they could employ you better elsewhere, it sounds like.
Not only that, they made that a product. And after they made it a product, I remember the first trade show we went, we was the only computer system in the entire trade show. And there was a line going around our booth, maybe 50 to 100 people. They just wanted to see this thing.
Okay, so what year are we talking?
We are talking 89, 1990,
Okay.
right at the beginning of computers coming out, 286, 386. Kind of days. Long time ago. It was before the computer revolution really took off.
So you started looking at the insides of calculators, and then it sounds like you were looking at the insides of colons for a little bit as a salesman.
A lot of them. I was taking pictures of inside of the colons.
Well, I think going to stocks is probably a good move, I think.
Well, stocks was my hobby. My best friend, when we graduated, who also lived in New York at the time, he was the one that was trading stocks and talking about strategies. And it was like a foreign language to me, but we were very close. So I was hearing it all the time.
Was he working? Like, did he have a job in finance?
He did not. He just traded. He was very wealthy family, and he decided to just trade for a living. And that's what he did all day long. He had another partner who did the same thing, and they basically had a trading business together. And he talked about it all the time. I remember when he was trying to explain to me what options are, what calls, and what puts are. And it was like he was talking Russian to me. It made no sense. Now I can teach it, but at the time, it was really a foreign language when he was talking about that. And I bought my first stock based on his recommendation. He had figured out some stock was going to do well.
Do you remember what it was?
I don't remember that one. It was not a big stock, whatever it was.
Did you make money?
I did, but not much. I bought just a little bit, and it went up and sold it very fast. With his recommendation, I didn't know what it was doing. So I bought a stock and I sold it, and I made a little bit of money, and I realized, what does it mean to be in the business of trading? You can make money by buying and selling. That was like my first exposure. I had never even heard about this.
Now, how did that feel, though, when you made that money and it wasn't like physical labor, it was just buying and selling? How did that feel?
Oh, that felt really great. But at the time, the only understanding I had, the only people that can make money in stocks are the ones that have insider information. So I was asking anybody, do you know anything, any information about a stock? Why should it go up? I didn't know anything about analyzing a stock. Nothing, absolutely zero.
Okay, so what changed? What sparked your interest, and when did you start getting more serious about it?
Well, Hiroshi, I mean, he was so close to me. He died in a car accident several years after I moved to New York. Very tragic. And I stopped thinking about stocks for years. And then I always thought about him, and this whole idea of stocks was on the back of my mind. And when I started looking into stock market again, it was kind of felt like I'm doing it with him or in his memory. And it just felt right. So first thing I did, I came across a book by Jake Bernstein, who is a seasonality guy, very old seasonality guy. Bought the book and I took a look at it. It came up with a lot of seasonal charts. It was just buy this. It wasn't stocks. It was all futures and commodities. Buy this futures at this date and sell it on this date and expect XYZ percentage gain. It made no sense because it didn't say why. It didn't say how did he do this. It was just these charts that said buy this date, sell that date. No other information was there. So it gave me the idea of seasonality as something that may be a good idea. But then again, it was futures. I wasn't doing futures. I put it aside, but it planted the seed of seasonality on the back of my mind. Now I'm a very good programmer and I liked stocks. I started reading books. I learned options. Finally, I was so into it when I realized how complex like Black-Scholes is. I love complex things. I even learned to derive the formula for Black-Scholes. I understood it really well and I started looking for edge. How do I actually trade these? And I found out about indicators, technical analysis. And I started studying all of that. I learned about fundamental analysis and then realized that's beyond my abilities. That is way too complex for me to comprehend. So I just went back to
That's interesting, because I think most people would say the opposite, that Black-Scholes is a little more complex and fundamental analysis seems maybe a bit more straightforward to most people. That's interesting that you'd say that.
Well, it's all the context. I had the context of math. I didn't have the context of business and understanding what's a healthy company versus an unhealthy company. The context, absolutely right. But the context for me, when it's math, is much easier for me to comprehend.
What kind of books were you reading? You mentioned the Jake Bernstein one. Is there any other ones that stand out?
Oh my God, I have a library of market books. I can pull them out. It's right behind my green screen.
I just wonder if there's anything that comes to mind you'd recommend.
Well, I have the best options book.
Why would you hide all those books behind your green screen? That's a great background.
Well, I need a green screen. Here, this was the book that I learned options with.
Oh, okay. Options, volatility, and pricing.
Yeah. This is a book that I learned the math of the options and also all of the basic option strategies. This is my favorite book. I have at least 10 other ones on options, but none of them did better than this for me.
Who's the author of that?
They're Nettenberg.
Huh. Okay. Options, volatility, and pricing. Nettenberg. All right.
Yeah, it's a fairly old book.
Yeah.
But if you're into math of options, it's in there. But it also teaches you the strategies with options. So I became an expert in NinjaTrader and started creating all these indicators or downloading it if I could find it and created strategies, back tested everything. But there was something missing in here. I just couldn't put my finger on it.
Now, were you actively investing or were you just kind of testing your stuff first?
I was trading. I was trading as a hobby here and there. Whenever I could, I was trying to understand if any of these strategies can work consistently for me. And I wasn't able to get consistency. And what I mean by consistency is, of course, I had multiple wins, but whenever I had a loss, that was devastating because I didn't know why I lost. I didn't know what my odds were. And it actually kind of stopped me from putting another trade in. What if the same problem happens? I was trading blind and that bothered me. I couldn't get myself to scale anything at that level. So I was just playing around. Then I came across Elliot Wave theory. And I learned about Elliot Wave theory from this TV ad that made a joke about the most complicated analysis system, which is Elliot Wave. And that's the first time I ever heard about it. So I'm like, oh, I got to know what Elliot Wave is. I went and got the Robert Prechter's book. I read it at least 3 times. And for some reason, it made sense to me. And To this day, I know it really, really well. And I can't tell you how much money I've lost because of Elliot Wave.
I wasn't sure where you were going with that. So, okay, because the context most of the time when I hear about Elliot Wave is that, yeah, it didn't work for a lot of people. So you're saying the same thing.
My God. If to this day, I don't understand, this is one of the mysteries of the world, like one of the 7 wonders. This is the 8th wonder, is why is Robert Prechter's Elliot Wave newsletter the most successful newsletter in the country? He's been bearish for 30 years. He's been wrong consistently, except for whenever market went down. So my broken clock is right twice a day too. That's not even, it's not even like a broken clock. Broken clocks work better.
Well, yeah, because I wasn't sure if I was going to have to hold a straight face as you went into how wonderful Elliot Wave theory was. So I'm glad that's how that ended. Okay, good.
Oh my God. I can tell you that one of my subscribers yesterday, I got sent an email about Elliot Wave to me, and I replied to him and I told him the only time I've ever seen Elliot Wave have some usefulness is when markets drop. Elliot Wave can bottom at the 4th wave of 1 lesser degree. If anybody knows Elliot Wave, they know what 4th wave of 1 lesser degree is. That's the only time I've seen a little bit of helpful hint from Elliot Wave, but otherwise Elliot Wave is useless.
So did you try trading based on the Elliot Wave theory?
Yes.
And?
There's no signal. It's like there is no signal in Elliot Wave. And Robert Prechter being bearish for 30 plus years, now that he realized markets keep going up, when he keeps saying crash, now he says it's extending. Just like futures extend. Yeah, Elliot Wave doesn't tell you where the top is, ever. There's no part of Elliot Wave that says this is the top. And they try to figure out where the top is. So they don't even apply it right. It became a religion to them.
Well, when I see people posting, on X or something about it, it does seem they're very fervent in their belief. It is very cult-like.
Yeah, it's pure cult. Otherwise, it's the most useless thing I have ever seen. And you can ask me because I know it really well.
Okay, so where'd you go from there? You studied Elliot Wave theory, and you're like, okay, this isn't working. What next?
Yeah, Elliot Wave did work for me once.
Oh.
And that was in 2008.
Okay. Well,
2008.
A good time.
Guess what? I had subscribed at the time to the Elliot Wave by Robert Prechter, who was predicting a big crash of the markets in October of 2008. However, they also predicted a big crash in May of 2008, in January of 2008, every month in 2007, and the year before that, and the 10-year prior. But I happened to join just at the right time, and I saw this. That I'm like, wow, you're right. It's going to drop. and I was sure this was going to happen. So I placed not a very big bet, but I'm like, I'm going to go all out. I placed a $4,000 way out of the money short-term puts on S&P 500 when the implied volatility was unbelievably low. And implied volatility was low, although the market was trickling down. So the options were unbelievably cheap. I remember I bought some of the puts that I bought for 9 and 10 cents. I don't remember the exact number of everything that I had. I ended up I cashed out at 100x.
Oh, really?
I cashed out $400,000 from that $4,000, although it was higher. I think it went up to 1,000. I had no way of knowing when to get out either.
And this was basically just dumb luck that you had signed up at the right time, right?
Dumb luck. Absolutely dumb luck. I didn't know that then. I thought I had cracked the code. I thought I was an expert. I mean, how many non-experts make $400,000? I mean, it was, I'm telling you, I had confidence like I hadn't felt before, except something happened. Well, the newsletter that I was getting was really bearish. Even after the market started ticking up, they were still bearish. And I started placing more bearish trades. And I placed one huge trade, and I lost around 100,000 of that $100,000 on one trade. Now, I can tell you the euphoria of making $400,000 from 4,000 is out of this world, but losing $100,000, I couldn't tell you the psychological effect. I could not trade anymore. I couldn't trade and make money. I think I placed at least 5 or 6 losing trades in a row. And then I stopped. I stopped and said, I think I got to relax and go back to drawing board.
So now what? At this point where you're like, okay, the Elliot Wave thing is not working?
Oh, I was convinced that's not going to work. Although I still always wonder, one of these days they're going to be right. Not because of any reason being a broken clock. One thing I didn't tell you, in early 2000s, I still had that seasonality back in mind. And I had a period of time between 2 jobs when I had a startup kind of go away. And during those few months, I worked on a spreadsheet-based seasonal analysis for just a handful of stocks. I remember Dell and Microsoft and a couple of other ones I was looking at 5 years back. So I had some way of looking at patterns at the time. But it was so hard to do with those old slow computers that I kind of abandoned it. But I had started. So I had some idea about how to analyze seasonality. And then I worked as an internet consultant after 2 startups of mine kind of went away. And then after that job as an internet consultant for a couple of years, I got recruited by Verizon, actually by the CIO of Verizon, working directly for him, working on new innovations and new concepts and ideas. A lot of my patents that actually, no, all of the patents that I have filed was at Verizon.
You got like 16 patents?
I have 16 patents that I filed. I think my name is on at least 52 of them, collaborating with other people.
Wow.
Yeah, one of them turned out to be pretty big at Verizon. I was infringed by Apple FaceTime, which was really exciting.
Well, if you're going to be infringed, might as well be by somebody with deep pockets.
Yeah, and I mean, I've left there for many years, but even a couple of years ago, they asked me to sign something so they could refile that one patent. And that one patent is about how a video conferencing can start from a standard phone call, which is exactly how FaceTime works. But that patent was filed in 2001, but it was infringed by Apple in 2010, which is one of the reasons Apple finally gave iPhone to Verizon. It literally happened after that. So that was the one big one that actually had some movements. It was kind of fun.
But now, how does that work when you're employed at the company and the research is there? You don't see like any trailing royalties or anything from that because it's kind of the company's property.
No, but they paid us.
Okay.
We got like $1,000 or $1,500 per patent.
Oh, okay.
But it was work because we had to write things up and we had to be screened to make sure that this is actually an idea that's patentable. So there was some work to be done, but that's how they compensated.
But I mean, probably if you could put a value on that technology, like it's tens of millions, probably.
That would be very valuable. Really, You need a business degree to figure that one out. But Verizon also told me that we only use these patents, especially that one, for defensive purposes. And
like for when it's infringed upon, is that what you mean?
Right. So if Apple would go after Verizon for something, Verizon would show this that we have defensive patents against your patents for different reasons. So that's how Verizon lawyers told me they were going to use that one. The CIO left, so I ended up leaving Verizon, went to Avaya, which is the phone company. So I'm still in telecom after spending so many years in medical world. Then Avaya just downsized to 1/10 of the size. So they got rid of all research and development. And then I was out of a job with time. So what I did, now I'm a very strong programmer. I took 9 AI and data science classes.
Okay, so I
And
saw, is that the Coursera stuff?
Coursera.
Okay, yeah, I saw that on your LinkedIn, and I was wondering, would you recommend that kind of training? Did you find it valuable, the Coursera?
Oh my God, this was really a long time ago that I did this. So everything has been updated quite a bit, but absolutely. Andrew Ng, NG, he spells it, is one of the greatest instructors I have ever seen, really made it understandable. And I really understood AI when I had no clue about it before I started these courses. Very, very powerful. And you know who Andrew Ng is, right?
I know the name. I don't know who we're talking about.
He is the one, and his team, I believe they are the ones that figured out NVIDIA's GPUs can be used for AI training.
Oh, okay.
Because NVIDIA was just into gaming and display
Right.
cards. He's the reason NVIDIA is what it is today. I am not 100% sure, but from what I've read, he had a big part of this.
Now, he didn't tell you at that time to buy NVIDIA, did he?
I wish he did, but no. You know what really hurts? You don't know how many times I've traded NVIDIA options, and I'm like, what if I kept them? What if I had a leap option on NVIDIA? I could have made tens of millions right now, not thinking about it. But so after I took all those classes, I landed a job at a AI company, medical AI company, Codemetrics, which is still around, as a AI researcher, which was just wonderful. It was a new world. AI was just coming up. This is before ChatGPT, before LLMs took over.
Now, did they hire you on the basis of the Coursera credentials?
Yes.
Okay.
And that I knew the CEO helped
Oh, I guess.
of that company, but that wasn't enough. They got into a desperate time suddenly. Somebody had to take a leave of absence who was in the AI group, and they needed somebody that understand AI to support their main researcher. And they didn't have time to hire somebody. They had just started. So I lucked out. I would have never been able to get a job like that. But then that was wonderful because I gained incredible experience in artificial intelligence. And more important than that, data science. I learned how to manipulate data. And then another college friend of mine approached me. He had started a new startup. It was funded, it raised several $1 million in the legal industry, and literally somehow talked me into leaving a job I really liked and running the development for this new startup. And that was not quite as fun as my AI job.
What did they lure you in with stock options or what?
Oh, quite a bit.
Yeah.
Yes. Yeah, I was, unfortunately, because it was somebody I knew well, I didn't do technical due diligence to find out why they're doing this, which was very stupid. I will never make that mistake again. That was not a viable business plan. So after the money ran out, although I finished my job, platform was working perfectly. They couldn't raise any more money, so they couldn't market it. They could not market this. And then I found out there's these websites were a dime a dozen out there, like lawyers.com. You don't go and reinvent the wheel. I mean, I made a mistake going there. So, but something happened. When they were looking for money, I was asked to sit home and wait until the money comes in. Software was done, so I really didn't have much to do. So I had to entertain myself. And to entertain myself, I decided to go back to that seasonality thing that I came up with 20 years ago.
Except now that you had more computing power, probably.
More computing power, but now I was a data scientist and an AI expert, and that idea never left the back of my mind. So I started working on data analytics, a true data analytics for a pattern detector in securities and stocks. And I was playing with it. Literally, I was thinking I'm making something. So when I go back to work, I have this platform that I just made for myself, except they couldn't raise money. And after 5 or 6 months, I was told that that's it. We are not going to be working anymore because we can't raise money. And to this day, I think they're still trying to raise money and they haven't. You're talking about 5 years. So suddenly I'm looking, okay, I don't have a job. I don't have anything, but I have this software that doesn't look bad. So I thought about, oh, maybe I'll just complete this and use it for myself. But as I was finishing it, it just looked really powerful. And I kept working on it, and it looked like a tool that I thought about 20 years ago, but much better and more powerful than that. So I decided to, instead of going and looking for a job, I'll just make a business out of this. So I created the software that I call tradewave, which is a data analytics platform for seasonal stocks. And that's how I got here into the world of finance.
And what it does is it analyzes seasonal patterns in stocks and then tries to give you actionable trades based on that seasonality?
It doesn't give you actionable trades. It gives you raw seasonal data. It tells you, for example, between today and let's say October 21st, last 10 or 20 years, Microsoft has gone up 9 or 10 out of 12 years. And it has gone up with an average of, let's say, 8%. It finds those patterns whenever it finds consistencies. And the entire idea came out of, I remember my daughter was in high school and took economics. And there is this stock market game that they had. The stock market game is basically they all have to, from certain day in the beginning of the semester, they have to pick certain number of stocks. And by the end of the semester, whoever stock has gone up the most wins. I was actually just talking to her about that. Can you imagine if you had TradeWave then? That's exactly what TradeWave does. Exactly.
So did you help her with that?
Not then. I didn't know. I didn't have this capability at the time, but now I do. Grandchildren. Grandchildren will win.
Okay, so now that's your full-time, and is it Terra Data Research? Is that kind of the company name?
Terra Data Research is the name of my company. The name of the website is tradewave.ai.
So people, if they want access to that, it's on a subscription basis or something?
Well, there's free, you can sign up for free. You can sign up for free emails, but if you want extensive capabilities, then yes, there's subscription also, but there's substantial amount of free capabilities in there.
So why are you giving it away for free?
I like to give things away to people. So the problem with this environment is it is so unfamiliar to people. So many people have looked at this and not understood what they're looking at. Then when I show it to professionals, they're blown away. Hedge fund managers, like another really world famous trader who discovered me, Anne-Marie Bind, she just immediately got it and told me, I can't believe such thing actually exists. So although so many people told me I was crazy when I made this in the beginning, finally some people have verified it for me, like them. And I like the idea of making this the third pillar of analytics. People have either know to use fundamental analysis or technical analysis or just word of mouth and news. Those are the only ways people know about stocks. Well, this is another one, except it has advantages that you cannot get with fundamental and technical analysis, like an environment, seasonal environment. It actually finds and ranks opportunities for you based on the day of the year. This is the day that certain stock has bottomed and started going up, and it ranks it. It's been happening last 10, 15, 20 years. So what are the chances for it to go up again? Is much higher than not. So it gives you ability to trade with odds.
So how active are you with your own money now? Are you looking to put on trades on a daily basis, or?
I put trades on and off myself, but the problem with running a business and trading, they don't go together very well until I have more staff. I am going to start, I have my paid subscribers are going to have their special class starting in October, which I'm going to start putting trades. But I only put short-term trades for demonstration purposes. But if I put too much money in there, I'm afraid that my focus will go on trading and forget about the business.
Yeah.
I got to do both. So as I build the business, I'm going to be trading more.
Walking people through it as you're doing it.
Right.
Is that right?
But
okay.
I know every trading strategy there is. And I have a book, The 100-Year Pattern.
So when did you write that?
I wrote it this year, beginning of the year, and it was released in June.
And you can get that, I think for people who are interested, you can find it on Amazon. It's $1.99 for the Kindle version, $15.95 paperback.
Yeah, I'm keeping it low in order to make it easy for people to pick it up, but that won't last because it actually hinders the marketing. If I raise the price, then Amazon markets it through a bigger number of channels.
Right, because if they're not making as much money, then it's not in their interest to boost it up.
Exactly. Right now, it was in my interest in the beginning until and it actually did really well. For the first 2 weeks it was number one in stock market investing for 2 weeks. So that was pretty exciting that so many people got exposed to it.
Now, you mentioned your first trade was one that your friend had recommended. Now, what's your worst trade you ever made?
The worst trade I ever made was the one I made $400,000 in. Yeah, I may have made $400,000, but I think I lost millions of dollars of sanity out of that one.
So was this was Elliot Wave stuff? What were you doing? Were you selling short, or were you just?
I was constantly shorting
the
market. I thought world stock markets are going to drop to Great Depression levels. Literally, those are the words of Robert Prechter when they predict when the market crash starts, it's going to bottom at the fourth wave of one lesser degree, which is really near the Great Depression levels. It was something that I literally believed in, just like how people believe in religion with no proof. And this was very bad. So every trade I've made because of Elliot Wave was my worst trades, even when I made money.
The other question I usually ask is what is your best? But your best one was the one that you just got lucky on, though, with the wave, isn't it?
That was definitely my best and worst. It was the same exact trade. I mean, if you want to see what I lost the most money on, was the trade I did after that when I lost $100,000 trading pretty much the same way as I made that $400,000.
Well, you know what? I've spoken with a lot of people about this, and oftentimes the worst thing that can happen to you is to get lucky right away when you start investing. Like, get lucky when you don't know what you're doing, because then you think you know what you're doing and you keep doing it and you lose your shirt. Right?
That's exactly what happened to me too. But it did something to me, and it made me realize that I am a very mathematical and analytical person. And there's no reason for me to go and follow things that cannot be proven mathematically. And that's why I don't use Elliot Wave for trading. Although whenever I look at a chart, immediately Elliot Waves come into my
because they're stuck in your brain.
Yeah, it's stuck in there, but I still check out to see if a retracement is at fourth wave on one lesser degree. The only thing I like about Elliot Wave is that only thing. Nothing else makes sense for trading besides that.
Okay, so we got your first, we got your worst, we got your best. What's the last thing you bought? What's the last trade you made?
I think it was a week ago. I did a trade on CF Industries.
Yeah.
I did a ratio back spread for a credit, waiting for CF to take off. There was a seasonal pattern that CF for the last 10 years have gone up during that time. So I placed this ratio back spread on that one, and the CF dropped $8. So I ended up making $5.
Hey.
On a loser. Those are my favorite losing trades, is when I still make money.
Yeah, $5 is better than minus 100,000, I think.
Exactly. Those
So
those are wonderful to do.
So what's okay? Can you explain to us as simply and briefly as possible a ratio back spread, or it can't be done simply and easily?
Oh no, it is. So ratio back spreads are great option strategy when you expect a major move in a short period of time. And by major, I mean 10% or more. If you expect that using a platform like TradeWave, you can find those opportunities. Of course, might not happen. So you actually have to plan for it not happening also. So let's say I expect it to drop. I like to do ratio back spread on shorts because they move much faster than a bullish opportunity. So let's say a bullish ratio back spread would be when I sell an expensive call option, then I go out of the money from there and I buy two cheap calls, which pays for the one that I just sold for a credit. When I do this for a credit, which is what happened with CF Industries, then as long as if it goes up 10%, I double or triple my risk capital. If it drops sharply, I'm going to make whatever credit that I got. The only time you have a risk is if CF Industries closes between the two strike prices of the options. Then you have some risk. So if you plan for that and do this with a stock that is really volatile, chances are not very high that it's going to not move. So you can make it pretty low risk.
Okay.
Does that make sense?
Yeah, it's interesting. A lot of the people I've been talking to lately are really deep into options. So, I mean, I think it's taken off a lot now, especially with, 0 day to expiry. In the old days, I remember trading options and you're paying, I don't know, $29 a contract or something. But now people are getting free option trades. So I think it's taken off. The volume certainly would indicate that it's taken off.
Yeah. I do a lot of option trades. Another one that I do and I really like is at the money credit spreads. I do that when I don't expect a major move, but I expect a move.
Can you walk us through that?
Sure. That is when I do it at the money. So when you're at the money, let's say if IBM's at $100 and you can buy and sell a call or a put option, depends on if you're going bullish or bearish, right above and below the price of the stock itself. What's great about this, if you know much about options, volatility is always an issue. Time value is an issue that people have to care about. But if you do at the money credit spreads, the volatility risk and the time value risk cancel out each other between the option you buy and sell. So a lot of that risk is gone and it becomes purely a directional play. You have a limited loss and you have a limited gain, and it just has to move several percent in your direction before you can successfully get out. I did, I think, 34 of those trades during one of these experiments when I was doing it for subscribers. It was last year, I believe. And out of 34, I made money on 30 of them. And 4 of them were losers. So it worked out pretty well. And it only lasted 1 to 5 days for each of those trades. And I actually have that in a chapter in the book about how that works and how I did it.
All right. So you're not super active on Twitter, or are you?
I am not much active on, but I just started posting on Twitter.
Well, it's kind of, I don't know. I feel like I don't want to jump on the bandwagon and say it's headed downhill like everybody else is, but I don't know. It seems like it's changed anyways. But
Yeah.
I think for finance, it's still pretty good. There's still a lot of good finance on there. So, but if people want to get a hold of you, you're on there, and it's at Afshin Moshrefi, and that's AFSHIN MOSHREFI, right?
Yes.
Okay.
Yeah, you can also always send me an email at afshin@tradewave.ai.
And tradewave.ai is the site where they can access the software.
Yes.
And the book is The 100-Year Pattern, and that's available on Amazon. Anything else you think our audience should know that you'd like to share with us?
Well, there's one thing that I came up with, which is written quite a bit in that book. And I think it's a great thing for everybody to take a look at. One thing I discovered through time, and research using the platform, because originally when I built the platform and then I started looking at it, I didn't know what the data said to me. It took about a year of playing around with it before I started understanding what I was looking at. Although I built it, it was just the data and analytics. Then I had to become a user and try to use it. So something I discovered was a feature that I built in there. I call it presidential cycle analysis. And that's taking a look at patterns based on presidential cycle years. And by presidential cycle, I mean you have PE years, which is the year of a presidential election. Then you have PE plus 1, PE plus 2, PE plus 3, and then back to PE. That's how I look at it. Each of these years have a different characteristic on the broad markets. And it's staggering how accurate and how consistent it's been throughout the last 100 years. And that is the reason for the name of the book being the 100-year pattern, is discovering these presidential cycle analysis patterns. And they're all in the book. Some of the most interesting things that I found is I put out a video on April 6th of this year. Based on this analysis, I saw that starting April 7th until August 2nd, there was, based on last 50 years, 100% chance market was bullish. And I made a video on that one. And market didn't let me down. It went up 25% during, and I have a video. It came out the day before it started, the move started. And this is during the tariff Armageddon, when people thought market was going to collapse because of it. And I became bullish, although psychologically, I didn't believe it myself, but I did make the video. And I said, I don't believe it, but TradeWave does. And it worked. It works perfectly well. But now there is something else is happening. Starting October 27th of PE plus 1 years, which is this year, until the end of the year, the market has been bullish every year since 1973. So I expect this year to be bullish into the end of the year. If history repeats, it has to repeat this way. The next year, which is a PE plus 2 years, is the first half of it is extremely always volatile down. It is probably the worst time in the broader markets if you look at it as a whole.
That's the beginning of PE plus 2. Is that right?
Until a magical date of September 27. It's going to be, I'm not going to say bloodbath, but there's a chance for it. Even NVIDIA shows a major drop during PE plus 2 years, starting on end of March for the next few months. It's going to be ugly. At least this is what's happened in the past. But now here's the magic date that I have found with TradeWave, and the real reason I call the book the 100-year pattern. I found a period of time. Listen carefully to this. I found a period of time, 295 days, that repeats every 4 years. This period of time, which is 21% of all the trading days, is responsible for nearly 70% of S&P 500's cumulative gain in the last 100 years. I'm going to give you the dates, but
write them down.
Yeah, I think everybody should write this down. And by the way, these big names that I talk to, they're like, we are publicizing this because they understand it now. This period of time, which is from September 27th of midterm election years, or P plus 2 years, lasts for 295 days until July 18th of the following year. This 295 days, S&P 500 has never gone down since 1930. 1930 was the last time it went down. This has been a bullish period for nearly 100 years, and no one has documented this until the 100-year pattern.
Well, okay, so we're recording this right now. This is September 29th, and we're in PE plus 1, right?
Yeah, this is next year.
Okay, so I got to have you back on in like about a year's time so we can talk about it.
No, you should schedule it now.
Yeah. Because it will be just into that time. Okay. Well,
Yeah,
that's
I even have
fascinating.
a video on it on my YouTube channel. That video shows you the actual bar chart for each and every one of those years. The only year that's not done extraordinarily well was 1978 during the oil crisis. It was flat. It didn't go up or down, but it ended up closing flat. Every other year has been a major boom during this 295 days. And you know what? Institutions know this. And I know they know this. Otherwise, why would the volume go up? Why would prices go up every single time this period occurs?
Really, if enough people know about it, then it should almost become a self-fulfilling prophecy, right? If everybody knows that, then people should be wanting to belong during that time, right?
Yeah, because the big trading firms are buying.
Yeah.
They're buying. They're not buying it because somebody hypnotized them. They have an army of PhDs figuring out this is the time to buy.
So what is your YouTube channel? How do they find that?
It's at tradewave.ai.
Okay. So if they search that, they can find that as well. Okay.
Yeah. Also, if you go to tradewave.ai and go all the way to bottom, there's a link.
Now, have you found recently with the explosion of, LLMs and more computing power, has that changed the analysis you're able to do, or is that going to change what you do going forward?
Well, I do use LLMs for so many things, but let me tell you this. Anybody that tells you they use AI to get their trading signals, stay away from them. Artificial intelligence does not know how to figure out when to get in and out of the market by itself. What I use artificial intelligence for is to calibrate the historical probabilities that TradeWave calculates. Then I have an AI try to calibrate the probability based on more recent data. That's how AI is used by real professionals, is you create a assistant wrapper to improve things, not to have AI trade for you. We're not there. Of course, people can create models that is based on non-AI and then use AI to help it. But AI is an assistant. It's not solution to trading.
Okay. All right. Well, thank you so much. This has been an excellent conversation. Thank you for being so generous with your time. I will include all those links in our notes when I post this so that people can know how they can find you and they can check out the book. Thank you very much for coming on. This has been a fantastic conversation. I learned a lot, and hopefully our listeners do too.
Thanks, Terry. That was awesome. I appreciate it.
Back to the Magnotta Winery shares that I mentioned at the beginning of the episode. I purchased them because they had such a great dividend yield. I bought them in February 2000 for 95 cents. In March of that year, so a little over a month later, they announced they were canceling the dividend. I held on for just over a year and sold them for $1.07 a share in May of 2001. Now, remember at the time, I'm paying these hefty $29 commissions on every purchase and sale. So in that just over 1 year holding period, I earned a hefty profit of $2. That's a compound annual growth rate of 0.3%. So less than 1%. Lessons that I should have learned from this, but I'm maybe still learning, is that when a stock has a yield that seems too good to be true, it probably is. Even though a company hasn't announced that they're going to cut their dividend, there are people that are analyzing this stock and watching the cash flows. And oftentimes the price reflects a high probability that there will be a cut in the dividend. And so the yield goes up before it's actually announced. We've seen this happen over and over again. And unfortunately, I've been on the wrong end of this trade several times, once with AT&T, I think once with GE as well. A couple notes from that episode. Afshin mentions a book by Jake Bernstein. I think the one he's talking about is Seasonality. It came out in 1998. You can get that one online for about $20. But he also wrote one in 1990 called Seasonal Futures Spreads. And that one, if you look online, you have to pay about $100 to get a copy of that one because I think it's out of print. He also talks about Black-Scholes. And Black-Scholes, if you're not familiar with it, is a fairly complex formula. And the guys that came up with it actually won a Nobel Prize for their work, or they won what's called the Nobel Prize in Economics for their work in creating it. You'll see lots of people talk about it online in regards to pricing options and how they trade options. Now, when Afshin says he understands it, I believe him with a background in physics. If you understand lots of calculus and probability and you study Black-Scholes for a good amount of time, then you have a good chance of understanding it. If you don't have a background in calculus or probability, the likelihood of you actually grasping all the ins and outs of Black-Scholes are slim to none. When people tell you that they understand it, I would question them what their background is in mathematics. I think there's more people that use Black-Scholes than actually understand it. I would argue that the people who created it maybe didn't have a great understanding of it as well. For those of you that know the history, the creators of Black-Scholes ended up affiliated with a company called Long-Term Capital Management. So they won the Nobel Prize in 1997. And in 1998, their hedge fund, Long-Term Capital Management, almost caused the entire financial system to collapse. The only reason it didn't was because their hedge fund was bailed out by a group of large banks that were basically going to lose a pile of money if they didn't bail out the company. In the end, the investors were wiped out, but they kept their Nobel Prize. Afshin also talked a lot about Elliot Wave theory. The originator of that is Ralph Nelson Elliot. He was writing on this between the world wars. I think he published his book on it towards the end of the Great Depression. Very fresh in his mind was the stock market crash of 1929 and how investor psychology impacted that. While you could credit him with being one of the first people to talk about behavioral economics as it relates to the stock market, although he didn't use those terms, I think most people would argue that Elliot Wave theory is not a sound basis for making investment decisions, and it's certainly not one endorsed by this podcast. Another person that Afshin referenced, and I probably should have known who he was Andrew Ng. He's currently on the board of Amazon. He's a former professor at Stanford, and he was one of the pioneers of using GPUs for machine learning. I'm thinking of including a segment called Questions from My Wife. She listened to the last episode with Paris Clough, and she asked me, what are QQQs? I'm assuming that people listening to this podcast are interested in investing and have some background knowledge in some of these areas. But for those of you that don't know, a QQQ is the symbol of an exchange-traded fund that tracks the NASDAQ index. And that is a group of 100 stocks that trade on the NASDAQ. It tends to be tech-heavy. And if you had been a holder of that ETF, QQQ, you would have done very well. It's outperformed the S&P 500 by almost 2 times, I believe. I realize that sometimes guests on here get into a little more technical things that not all of our listeners might be familiar with. I'm thinking of maybe starting a segment where I answer some of the questions or go into the background of some of the things we've talked about. Maybe I'll put it for subscribers only or something in the future. If you do have questions about things that were mentioned and you want a little bit of a deeper dive into something, please send me an email. You can get a hold of me at terrymhogan@gmail.com. You can also find me on X at Terry M. Hogan. Please remember that everything discussed on Terry Hogan Talk Stocks is for entertainment and or educational purposes only. This is not investment advice. Do your own due diligence. I'm going to leave you with a quote from Warren Buffett. My view of the general market level is that it is priced above intrinsic value. I think the probability is very slight that current market levels will be thought of as cheap 5 years from now. And that, my friends, is from his partnership letter that was sent out in 1957 when the S&P 500 was trading at about 12 times earnings. Today, it's trading around 28.